Welcome to another episode of Lunch with the Shark. Join us as we dive deep into discussions about business, accounting, and finance to help you build a business that thrives. Now sit back and have a bite with your host, the Shark CFO, Vidal Espinosa.
Well, hello, good afternoon. Welcome to a new edition of Lunch with the Shark. I am your host, Vidal, the Shark CFO Espinosa, and it's really nice to be here with you on this Thursday afternoon. Damn, it's Thursday, December the 3rd. I know that they have asked me not to say the dates or the day, but I did it already. Sorry guys. So December the 3rd, and this week, as you've noticed, we are talking about tax planning. It's not too late to do some tax planning. So today, I think we're going to talk about, they're telling me to give you just five tax strategies or 5 ways for small business owners to reduce their taxable income. But I don't think I'm just going to give you 5. I'm going to talk about the 5 that they gave me to talk about, and I'm going to give you several more. But first and foremost, we're not telling you to do them, okay? We're not telling you how to do them, okay? Because whatever I am saying here, it's just the tip of the iceberg, okay? Don't assume that every single tax strategy that we've been talking here for the last several days, fully applies to you. Today we're going to talk about one of them, one strategy that it's extremely helpful, and it can save you a lot of money. Okay, so what we need to do is we actually need to know, where do I stand? Where is my business at? Where is my where's my problem reside? Like, I have a client right now that so far has $4.5 million in profits, that we need to determine how are we going to strategize legally and reduce their tax liability. How can you do it? It's December. Nevertheless, okay, they're not on a natural calendar tax period. Right? You didn't know that. Are you on a natural calendar? If you're a sole proprietor, LLC, single member, you are a natural calendar. Do you see how important it is to know your tax code, or understand it at least? Because if you're a sole proprietor, Schedule C, LLC, single member, as a pass-through, there's no other option, because your tax return as an individual is due on or before April 15th. Now, there's rumors around there that this year the IRS Congress might extend the deadline to file and pay your taxes all the way to July 15th. Okay, it's not approved yet. There's talks about it, but nevertheless, taxes are due on or before April 15th, and tax return is due on or before April 15th for the tax year of 2020. Okay, so be ready for that. Now, let's start by understanding or realizing that you don't know what you don't know. Okay, and there's a lot of tax strategies. I don't want to say loopholes because really I don't want to. So there's a lot of tax strategies that you can implement, and we don't know 100% of them. It's very difficult. Every tax advisor might prepare or might do different tax strategies. There's other tax advisors that want to have every single client of theirs fall under just one or two or three strategies, and that's it. And a tax strategy or tax planning, it's nothing that it's do it yourself, first and foremost. And second, it's a couture item. It's done to your measurements. Don't try to go to YouTube, go to Google, and do, tax saving strategies. Yeah, they might say, hey, hire your children, and their income is fully exempt. Okay, yeah, that's true. Yes, it is true. But there's a lot of things that you need to check mark. Yes, you need to check mark before that is true. If it was that simple, every single individual that has kids would get those monies to them tax-free. It's not that simple. It's like when people say, hey, open a business so you can deduct certain personal expenses. First of all, it's not right. It's illegal. Second, if you really don't have a real business, a true business with real clients, your husband, your wife, your kids, your grandparents, your family, your parents, if they're buying from you, you need to prove that. There's ladies, I did. One lady came to me several years ago, and she said, "You know what? I have a W-2." Okay, so perfect. And then we calculated their tax return, and she owed like $10,000. She said, "Oh, by the way, I forgot that I had registered myself to sell a bond." I'm like, okay, and it was like like people that sign up for Narium a couple of years ago, and they only sold one or two items to themselves, and they said, "Oh, I'm self-employed." And I was like, okay, and did you sell anything? No, but I had expenses, my mileage, my this, my that. And I'm like, okay, so you had no sales, but you do have mileage. Why would you have mileage? And she's like, oh, because I went to visit a client and you did not sell anything. No. Okay. And how long have you been doing this? A couple of years ago. And did you reported that last year? No, because I had a refund. Okay. We did not help her. We actually could not have helped her because, I apologize, sorry, it's too cold in here. That's not a true, real business. That's considered a hobby. and she cannot deduct those mileages. She cannot deduct those meals and entertainments because she was out on the road selling Avon. And I'm like, just going a little bit more deep into trying to avoid a more complicated situation through an audit, right? So I said, okay, let me just review that just to give you the benefit of the doubt. So I went and she provided me a couple of bank statements, and I saw, like, on a Monday or on a Wednesday or on a Thursday, lunch, not meals and entertainment, that she claimed that it was for her Avon self-employed job or company. And it was like $7 something, $7.50, $8, $9, like at 12:30 on a Thursday afternoon or on a Wednesday. And I'm like, did you work this day? Like, you're a W-2. It doesn't make sense, right? So if it doesn't make sense to somebody that it's an advisor or somebody that knows, it's not going to make sense to an auditor, to a tax auditor, either from the federal government or from the state. And as soon as they find one or two little things there, they're gonna dig. They're gonna dig, and they're going to, they don't like that, okay? They don't like that because that's mostly being cheated off, okay? So be very careful on any strategy that you hear out there or see out there. Be very careful on how you implement it, who implements it, when do you implement it, and don't try to do it yourself. Tax planning, it's not a do-it-yourself project, okay? Painting your room could be a do-it-yourself program, thing that you do on the weekend. I don't know, building an IKEA bookcase. That's a do-it-yourself project. And sometimes you can't even do it. They're a little bit complicated because instructions are dumb for IKEA furniture. So let's dive right into this, okay? So the first one, and I already spoke about this, is employ a family member, okay? One of the best ways to reduce taxes for your small business is by hiring a family member. The IRS allows for a variety of options, all with the potential benefit of sheltering income from taxes. You can actually hire your kids, regardless of their age. You can hire your kids. They need to work for reals. They need to do something for reals. Yes, you must have proof and evidence that they filed, that they shredded, that they swept your office, that they broomed your office, that they did anything in your office, okay? And you cannot pay them $100,000 for shredding documents. You can't. It must be a reasonable compensation for someone that you could hire out there for the job that you're hiring your kids, okay? So you must follow certain guidelines, okay? Oh, I'm gonna go hire my newborn. No, you can't hire your newborn, okay? What would a 6-year-old kid would be able to do? Maybe shred. You just tell them it's an action and they can just be shredding. It doesn't matter if they shred one page at a time. They're doing it, right? You can pay them minimum wage. Okay? And not everything, it's exempt. Okay? There's limits depending on your taxable situation. Okay? I think for 2020, I think that it's $25,000 that is exempt. I need to check on that. Let me see here. Every year changes. So I think that it's $25,000. Let me see. Well, oh well. There's a limit. Okay, there's a limit per kid that you can tax free. Yes, tax free, exempt. There's no taxes associated to it. Okay, no taxes associated to it. So that's a great way on reducing, okay, your income, your taxable income. Now that is a true business expense that you can actually deduct from your business expense through your business expenses. Okay, that it's going to be saving you a lot of money. Okay, a lot of money. So let me see here. Yeah, back in 2018 was $12,000 per kit. So sole proprietors and spouse partnerships can pay children up to $12,000. This number has already increased without incurring any tax, neither income nor payroll. And this is the key here, for legitimate services rendered to the business, and this is according to the tax code. Legitimate services rendered to the business based on a market rate of pay. Okay, S corporations and C corporations and non-spousal partnerships can also take advantage of this. However, they are not exempt from payroll taxes, Social Security, and Medicare. The business can take the deduction for the pay and on the child's tax return if it is less than the standard deduction. Here, I'm speaking to you maybe in a foreign language, but any tax advisors would know how to do it. And this is a $12,000 plus tax saving strategy per kid. Per kid. That is an amazing tax savings. Okay, so utilize it. Talk to your advisor. Number 2, and I think I'm going very deep into this, but I just want to make sure that if I'm giving you the recipe, at least I'm telling you most of the ingredients. Okay, start a retirement plan. Dude, yes, as a small business owner, you can give up to a 401k match by an employer. However, there are several retirement accounts options that maximize retirement savings, and they increase valuable tax benefits. For example, with the one participant 401k, and listen to this one, if you are a single member LLC tax as an S corporation, and I'm doing this on purpose, telling you exactly how it is, because as a business owner, you must know the terms. You must not fully understand them, but you must know the terms and differentiators. Okay, so as if you are a single member LLC, okay, taxed as an S corporation, you can actually put away through the company $57,000 in total contributions for retirement, and the company can deduct that. And it's not taxable income to you. Some of those retirement plan vehicles include simple employee pension plan, an IRA or Roth IRA, or a 403b plan. There are a variety of different retirement plan options for business owners call us. Call your financial advisor. But you must be an LLC. You know, I've been saying this over and over and over and over. Tax planning starts with the foundation of your entity. With the foundation of your entity. That's how tax planning starts. Wow. Isn't that interesting? Isn't that something that $57,000? That's a lot of money. That's a lot of money that you can deduct. Right? Right? Or no? It is. It is, because who doesn't want to save 57,000? And if it's 57,000 here, let me see here. 57,000 at the current rate is, you'll be saving $12,000 in taxes. I just gave you so far $24,000 in two strategies I've saved you. $24,000 in 20 minutes of us talking. $24,000 so far. Let's see if I can do $50,000. 3, save money for healthcare needs. One of the best ways to reduce small business taxes is by putting aside money for healthcare needs. That's why I have Obamacare. That's why I have medical insurance. Yes. But have you heard about your deductibles? Have you heard about your prescription deductibles? Have you heard about your dental plan deductibles? Let's just finish this by your vision deductibles. Plain and simple. You can accomplish this through a health savings account, an HSA, if you have an eligible high deductible health plan. Yes, yes, sir. Health care accounts, health savings accounts. You can actually save. Let's see it here. I do have a calculator. I am not cheating. I do have a calculator. And you can actually save your tax rate or your company tax rate by the total premiums. Now, there's a cap. Okay, they are capped. 3250, I think, for 2019 or 2018, 2020. So that's like $400 or $500. But if it's 3250 times 21%, that's $680 per employee. That's a lot of money. Remember, instead of giving an employee a raise in actual salary, which it's going to be, if you give them $1, they're not going to get $1 back. They're going to get, if they get $1 and you bump them into another tax rate, they're going to get 60% only, 60 cents per dollar that you gave them as a raise. If you really look into a fringe benefit or a cafeteria plan where you can give them tax exempt benefits, that's better. That motivates them because those are benefits. Okay, they feel more vested into the company. Number 4, change your business structure. As a small business owner, you don't have the benefit of an employer paying a portion of your taxes. You're on the hook for the entire amount of Social Security and Medicare. If your business is taxed as a limited liability company, an LLC, you still have to pay those taxes. Those 2 taxes, responsibility, okay? Those are your responsibility. This might be a wise switch for a small business. While there are many things to consider in this switch, such as paying yourself a reasonable salary and other associated risks, it can be a good way to reduce your tax responsibility. Personally, look, a sole proprietor, Schedule C, whatever your profit is, which is your taxable income. And remember, how do we determine taxable income? Gross revenues minus deductions or expenses give you the bottom line, which is your taxable income, right? For the business, for your self-employment, for your independent contractor services, right? Now, to that, you apply your actual tax rate. That's one tax. Second, to that, you apply 15.3%. That's your self-employment tax. If you were a corporation, S corporation, whatever way you're being taxed, the company pays 50%. It's your money, right? Yeah, but it's not on you, right? The burden, it's not on you. And then that 50% that the company pays, which is an expense, it's fully deductible, right? So it's fully deductible. So on that, you are saving some taxes. You save some money. You do save some money. Let me see here. So it actually helps you a lot. And I'll go here on my little calculation, my little cheat sheet, which is normal because we all have cheat sheets. The savings can vary between $3,000 to $15,000 plus. A sole proprietor operating with an LLC can elect to be treated as an S corporation for tax purposes. By moving operations off individual tax return, the 15.3 self-employment tax is fully eliminated, okay, on earnings up to $128,400 to the date that this was written, which was 2019. This amount increases every year based on inflation, okay? And then the percentage on your income, okay? S corporation shareholders are required to receive reasonable compensation from the S corporation. Remember, we've spoken about this. Saving calculation is based on the difference between the reasonable compensation and your income, right? Your taxable income, because this 15.3%, it's based on your taxable income. So the difference between that can make you or save you over $15,000. This is all a numbers game. That's why I say, fuck your numbers. This is all about strategy on seeing how you move the pieces around. Remember, Queen's Gambit. We look up to the ceiling, and then I see how the pieces move, and then this is your strategy. This is for you. This is what we need to do. And then we start playing with the numbers to see how we maximize your tax savings. And we are not cheating the IRS. We are not cheating the tax authority. We are playing with the numbers and keeping you compliant. Deduct travel expenses. If you travel a lot, you may be able to reduce your business taxes. Business travel is fully deductible through personal travel, does not enjoy the same benefits. Here's a tip. Let's say that you want to go on a weekend trip, but your business does not allow it, right? So what you need to do is, or what you can do is, set up a meeting on Friday, wherever you want to go, a legitimate business meeting for Fridays. And also set up a legitimate business meeting on Monday. That way, Saturday and Sunday becomes fully deductible. fully deductible from your business, and then you have it. You have a weekend paid by your company that it's fully deductible. Hey, is my wife or husband allowed to come? Yes. Are they part of the business? No. Then their portion is not deductible. If they're an employee, it is deductible. Do you understand? Do you see how this is? It's not a game, it's a strategy. It's a strategy. Okay? So I think I've given you very good tips here that you might be able to implement, not on your own, but at least ask your advisor. I highly advise you on stepping away from your home office deduction. That's a very common deduction that it's rarely utilized correctly. It's a very red flag for the IRS, because if you are not in business for your own, or you're in business on your own and you live on a 1,000 square foot, and you want to deduct your whole rent and all your utilities and this and this and that, it doesn't work like that. Look, I'm going to give you an example. If you're a daycare center and it's in your home, okay, right in your home, okay, you know what? I take care of my grandkids, and I charge. So that's a daycare center, right? Let's call it a daycare center. You have expenses, and you only have one bathroom in your apartment or in your home, which is not uncommon. Guess what? The IRS would disallow that portion of the apartment to be deducted as a home office or part of the rent expense. Why? Because the rule says that anything that you deduct from your home must be fully utilized, must be only utilized for the purpose of the business. So if you go into the bathroom in the morning to take a shower to get ready, you already are utilizing that bathroom for something else than for your clients or doing your business hours. Does that make sense? So that's not allowable. You would only be allowed to deduct the rent portion of the square footage that it's only 100% utilized for that daycare center. If they want to scrape and look into little things like that, they'll do it. And if they are already looking at you, they'll make life miserable. Trust me, they'll make life miserable. We've seen it. We've seen it. Okay? So just be very careful on what strategies you implement. Be very careful on just creating businesses to deduct certain business expenses. After 2 or 3 years of losses from your company, the IRS can come back knocking and say, hey, let me review your numbers, and I think this is not a business, this is a hobby. And you need to be very careful. Same as to when you're flipping properties or buying and selling properties. There's certain deductions that if the IRS says, you know what, you are not an investor, you are a reseller. That's it. You get pretty much 25% only on deductions out of the 100% deductions that are there for real estate investors. You're done. You're screwed, really. Because if you're doing it on your own, you're doing it wrong, you are not following advice, you really can screw yourself up. And real estate, it's a profitable business. And all those are either short-term or long-term capital gains, and you are going to be disallowed depreciation because you're going to become a wholesaler. And Every industry and every business has different chingaderas going on. Be very careful, okay? Another piece of advice. Never, please, never, ever mix different businesses into one entity. Why? Plain and simple. Each business has its own unique, necessary, and ordinary expenses. Okay? If you're a dentist and you're also a wholesaler, those are two different businesses. What the IRS is going to do is, okay, which has the highest revenue percentage of the two combined? Well, my dentist practice. Then we are going to disallow all the deductions or expenses for your wholesale, but your income, it's part of it. We are going to disallow the expenses, but we are going to keep the income. Does not make sense to you, not according to the law. So seek advice prior to combining different businesses into your one single structure entity. Oh, I am a chiropractor, but I am also a real estate. I'm gonna rent. I am real estate investor, and I have my properties on Airbnb. Well, the income, it's taxable. No deductions are gonna be allowed for your Airbnb business because what's the preponderant activity? Oh, I'm a chiropractor. Be very careful. Be extremely careful on how you do your business. Again, now, it's your business. You can do whatever the fuck you want, really. You can do whatever the fuck you want. At least know what you're getting yourself into. Bottom line, wise planning, you can reduce your taxable income as a small business owner and keep more of your hard and earned money in your pocket. Well, in your bank account. Just remember to consult a tax professional to make sure you qualify for any and all potential savings discussed here. Be very careful. This is not a do-it-yourself project, okay? So people follow us on YouTube, LinkedIn, Instagram, Spotify, what else? I think that's it. Twitter, and it's been great seeing you today. And I have not forgotten about our quote. And this quote was handed to me by Jesus. Yes, not Jesus up there or whatever he is, or on any Jesus that you believe in. Jesus, our community manager. And this is from an unknown source. And that person, he or she said, people who complain about taxes can be divided into two classes, men and women. So true. So true. Well, it's been great seeing you today. Have a great afternoon. Bon appetit. Ciao.
Thank you for listening to Lunch with the Shark. If you would like to set up a consultation with the Shark CFO, Vidal Espinosa, visit his website www.invictus-advisors.com, and don't forget to subscribe on Facebook, Instagram, YouTube, Twitter, and LinkedIn.